your patience. We were just working through a audio issue. So on today's closing bell, we have Mike Smith from Hawkeye Traders. He's going to be teaching us how he made 250% using volume and options last year. So he's going to be showing how he uses Hawkeye Volume Analysis to identify low-risk trade entries, analyze price action using volume, identify strengths and weaknesses across all major markets, enter using trend and volume signals, as well as managing and building positions. So thank you so much for coming on our closing bell, Mike. I'm really looking forward to it.
Thank you so much for the kind introduction, and once again, apologies for the slight technical delays. That was look, I'm talking to you from some perhaps as somebody suggested, some drones got in the way. But let's kick things off. It's wonderful to be here. It's always a pleasure and a privilege to share some of my knowledge with anybody who's happy to listen. We're all traders and we've all got different experiences. From my point of view, I've been in the market 20 years as an options trader, traded other vehicles as well, obviously, and I've been working with a group called Hawkeye Traders for just a little over 2 years now as an options specialist. Hawkeye Traders are essentially a software and education company. I'll just briefly mention them later on. I've been 10 years a coach, teacher, and consultant. And one of my sort of mantras is that really I want to see traders become independent and empowered. It's all very well listening to people like me and working with us on an ongoing basis, but really at the end of the day, we're not going to be here all the time. I would rather see. I know I've done my job as a teacher if at the end of the day somebody is independent and uses those around as resources rather than decision makers for them. So that's a little bit about me. In terms of where Hawkeye Options are, it's part of the Hawkeye Trader software and education family. As has already been suggested, we use a volume spread analysis approach, a VSA approach, which is a form of technical analysis which looks into price action in relation to volume. And really, I'm preaching to the converted in many ways. We know that sort of all of you on here, because you've been linked with Force, know that volume and supply demand and being able to see that is key. That and price are the leading indicators, and to have them as the basis of your decision making is obviously putting you in the best place. We offer an alert and portfolio service, and we trade across 8 different option strategies. So, okay, so look, let me first of all just briefly mention why options trading is my passion and why many people that we work with choose to add options trading to their trading toolbox, because of course many traders have multiple strategies and multiple vehicles that they trade. So why might options trading be something you may consider? First of all is that what I would term the power of flexibility, that each of you on here has different objectives, different time access to the market, different purposes behind your trading. And really one of the things about options trading is we can use it to fit multiple if you like objectives, multiple personalities and characteristics. So there's option strategies for everyone, if you know what I mean, in terms of how you can interact with the market. Secondly, there's what I'll call the power of opportunity. There's a chance to trade every different market condition, although admittedly what's happened in the last 6 or 7 months has been rather more challenging than perhaps last year, and we'll talk about that as we go along. And so with options, we're not just trading long or short, we're also trading in the range, and we're trading short and long term. So the opportunities there, I would suggest, are probably as great as any other vehicle. And thirdly, of course, again, I was on a webinar last night with Cyber Trading University, and one of the key messages that came across was that really at the end of the day, it doesn't matter what you trade. The rules of the game are very much the same. you've got the idiosyncrasies to learn about a specific strategy or a specific vehicle or an approach. But generally speaking, um, if you want to be a successful trader in the long term, then you've got rules that you must follow. And we're going to talk about those as we go along. And really, the basis of what we're going to talk about today is developing a trading edge. And really, what we mean by a trading edge is having something that gives you an advantage over other market participants. So it's not just about a specific indicator, although we'll talk about those. It's not just about having a trading plan. It's not just about what vehicle you trade. It's about you as an entirety, you as a whole trader, and what you do and what you don't do. Let me give you an example. 90% of traders don't formally measure what they're doing, and really, those who are successful, have set systems in place to measure not just what happens in individual trades, but all of the things that go along with that. And we'll talk about that again as we move forward in the next hour. So just to reiterate key points, it doesn't matter what you're trading, it doesn't matter what time frames or strategies you're using, the rules of developing an edge are the same. For each instrument, just to give you an ABC, for each instrument you're trading, and each strategy, you should have a purpose for its role for you within your entire trading. So it may be that you trade short day trading for a specific purpose in a specific way, and you may also have something slightly more medium or longer term going alongside that. You should also have a defined, written, comprehensive trading plan, which is specific enough to be measured in each component, and that should only be changed, really, if you have evidence that it's not working. And the problem with that is that invariably, from our experience, and I'm sure that the guys there will reiterate this, that quite often what happens is that people will trade, they'll use a set of particular criteria to trade, whatever indicators or whatever system, and ultimately it won't, or in the short term, it won't give them the results that they want. And really, the problem is not necessarily with the system. When we look at it in a little more detail, then invariably it's the way that the person's interacting with that system. They're not following it to the nth degree. They're missing bits. They're thinking beyond it. And so what they're doing is they're not actually testing the system. And so what happens then is they then change the system. They then add another indicator, or trade another vehicle even, or another strategy, and exactly the same thing happens. And then it happens again, and then it happens again. And really, the problem is that people aren't following. People aren't being disciplined. People aren't being comprehensive and in what they're doing to give them the results or to give the system a chance to give them the results it can do. And that's, again, something we see time and time again. And obviously, for each of these, you adhere to sound trading practice and treat your trading as a business. And we may talk about that later if we get time. So let's look at some of the components of developing an edge. Well, really, if we look at the purpose of entry, the purpose of entry is completely and absolutely to give you a high probability of it going in your desired direction. The bottom line is that it's not entry that in many ways determines your ultimate profit, of course, because that's exit. But what we want to give ourselves is the best chance of doing that. And with options, of course, and in fact with any vehicle, if you're trading different timescales and you treat that as a different strategy, then we need to choose the correct strategy to take advantage of the way the market is now, the current risks that are in there, and what the overall market is doing. So matching strategy to market is absolutely crucial when considering options as a trading vehicle. So what we do is we usually, or like an indicator, and we've already indicated this shows market sentiment before major market moves occur. And if we look at this chart of Microsoft, this is Hawkeye. I'm just going to give a quick rundown. So what we've got is a trend. which is green for uptrend, red for downtrend. White indicates congestion. The heat map, which is just relating to the strength of that trend. And we've got volume here. Now, this is not just volume in terms of how much, but also whether that volume was buying or selling pressure. And again, you know already from what you've been taught and been in these rooms before that whether it's buyers or sellers in control is the key point. And what we've got here is we've got a situation where if we have the combination of price and volume, we can look and see here we've got Microsoft going from downtrend into congestion, but we already see buying volume coming in before we hit uptrend. Okay, so we've got selling volume coming in before we hit congestion. And here again, we've got selling volume coming in. Well, it's still in congestion, indicating that it's going to pop downwards. And here again, you see that we've got buying volume coming from this bar here to indicate that we're potentially moving up again. So very briefly, that's what we're doing. We're giving ourselves an edge by looking at how the market's, how sentiment is going before a potential trend change. This just puts something on our hot list. It's not, we wouldn't act on this until trend has changed. But obviously it says, hey, look, this has the potential to do something. Secondly, we use multiple time frames to ensure we're trading with the market and reduce noise. So as a general rule, for medium-term option strategies, medium to long-term, so things like diagonal call spreads, which are like covered calls for many of you who know covered calls, except you're buying a long-term call option and selling calls over it on a weekly basis. You will tend to use a daily, weekly, monthly, and we're looking for evidence of buying volume across all three time frames. And you'll see it's green colored, and we're looking for uptrend in the top in the two fastest time frames. Trading with the market is always, or invariably creates a better thing against the market. And when we're talking about trading with the market and strategy choice, we'll look in very simple terms. What we can do is we can simply look at the index as a whole and potentially the VIX, which we'll look at in a moment. And what we see is really probably the most difficult market conditions to trade for a few years if you're a directional trader, unless you're trading very short term or intraday. So we've got, obviously we've got this choppiness here in a very tight range, less than 5% from top to bottom, and that's been in place since February. Even if you stretch it out to December, we're still trading within a 6% range from top to bottom. That hasn't happened for in excess of 100 years. And it's not just the fact that it's that it's fluctuating, but it's also some of the severity of those fluctuations, which makes it difficult to trade anything beyond the day if you were just trading directionally. Second, of course, we're going to look at the VIX. VIX is at really historic lows. We've got VIX invariably, for those of you less familiar, measures the implied volatility on options traded on the CBOE, and implied volatility or higher implied volatility is usually associated with a market that's getting more anxious. So there is an inverse relationship between the VIX and the S&P 500. So if we combine these two, then we can, along with 3 or 4 other things which really go beyond the scope of this presentation, but we can give you access to, which we'll talk about later on, then we can start to have an objective system for putting together a matching strategy to market approach. I taught measurement before, and this really is one of the crucial things about giving yourself an edge. There are various things we can measure directly relating to results. There are obviously other things we need to measure as well, or can measure. And again, I've mentioned before how important that is. But looking at the trading directly, we can look at profit loss, we can look at win-loss ratio, and we can look at average win versus average loss. And invariably, newer investors tend to look purely at win-loss. Then the next stage is the win-loss ratio. People tend to move on to that next, and then we start to look at the more important ones. And each of these should be looked at per strategy and in the context of market conditions. And only then can we, if we measure these and measure these well, only then can we start to make meaningful decisions about how well a specific strategy is working, how well we're doing as a whole, and more importantly, what we need to put in place to make some good things happen going forward. So let me give you just an idea about why looking at all of these three things is particularly important. Bear with me if you're new to options. I'll try and explain it in terms which are relatively palatable. We all know directional trading, so going long or short. And really, win-loss ratios, although interesting and important, aren't the major determinant in terms of whether you're successful or not. And I'm going to show you why in a moment. However, if you had a strategy which, like many of you are familiar with credit spreads, what we're doing with a credit spread is we're putting two optional legs away from the action with the trading idea it's not going to get anywhere near that during the life of those options. So what we're doing is we're taking the risk event away. We're making the chance of a risk event, i.e. a loss, being triggered by moving it away from the action. Now, in that situation, what we're looking to do is we're looking to scalp the market for quite a small amount of premium. So maybe 10 or 15% over a period of a week or 2 weeks. It's quite short term. However, if that risk event occurs, then we can lose, unless we've got a plan in place, we can lose 70, 80, 90%. So this is a 10% sort of premium that we brought in. So the potential for dollar loss is quite significant with a credit spread, and therefore a win-loss ratio becomes the most important variable to measure. Whereas with directional trading, we're looking really at that old market cliche of letting your profits run, keep your profits small. So we're looking to make our average wins significantly more than our average losses. And this is a period of time over 8 months last year where we returned 253%. And this was simply directional trading, and it was primarily, I think, apart from one trade, bought calls. So the days we were in the trade was between 2 and 23, and the mean was 9 days. And here's what I mean. If we look at this, these are the winners, obviously, these are the losers. And there were times when we had 4 or 5 losers on the spin. But the major difference between this, you'll see the length of the wins versus the length of the losses. And if we look at our average percentage of our winners, it was 65.54%. Okay, our average losing trade was a 21 average percent. So despite the fact that the win-loss ratio was almost 1-to-1 during this time, I think it's 28-27. So the win-loss ratio is 1-to-1. But because our average winning trade is 3 times, so our reward to risk ratio is 3-to-1, that's how we developed this to 53%. Now, that suited market conditions at the time. Obviously, it's sort of slightly different. So what are we returning? What are we returning this year? Well, the current, as I said, we have an alert portfolio service which is proactive in nature. The current return on that is 46% since January. So different market conditions not only merit different strategies, but will also yield different results. There are risks in this market which mean we would use alternative strategies. And just for reference, we're using a lot of diagonal call spreads. We're using very, very short term, or sort of less than sort of 2 or 3 days if we are directly trading with low position size, and that's the rarity, and some spreads. So really, if we look at the market conditions now, really single leg directional trading is out unless you're trading live, i.e. not placing conditional orders out of market, and then looking for low dollar risk scalping with smaller position size. And much of what you're doing already is congruent with that as a concept. So looking to scalp the market over a very short period of time and often intraday. So we're finding debit call and put spreads are working well, and butterfly strategies, which again, for those less familiar with options, are those which trade within a range. So we can put option legs at the top and bottom, and then sell some options in the middle, and as long as it stays within that range, then we make a profit. The problem with credit spreads is that generally they're at their best, i.e. we can put them further away from the action when volatility is higher. And as we've already seen, although the market's choppy, it is actually trading within a relatively tight range. Hence, the VIX is at lows. The standard being 18 or 19, it's around about 12 or 13 at the moment. So that makes it very difficult to do credit spreads unless you're, unless you've got a little bit of an extra edge, which I'm going to talk to you about. And longer term strategies are possible with diagonal call spreads I've already talked about. We'll get some questions in a moment. So looking at one of the other things that's absolutely crucial in developing an edge is looking at exits. Now, as I said before, the aim of entry is completely and solely to increase the probability of the trade going in your direction, where it's exits that determine your real deal profit, or minimize loss to within your tolerable limit, along with effective position sizing. So if we looked at, and use this as a little checklist, if we look at the exit component of your trading plan for each strategy or each vehicle that you're trading, then your system must clearly identify the following. It's not just simply a case of putting, well, I'll exit if this particular indicator does this. You need to identify how you're going to trail a stop up. You can identify there may be situations where tightening a stop, tightening your standard trail is prudent. And an example of this would be you've entered a trade. We're in XLU at the moment as a bought call trade with the idea that there's a resistance at 44, for example. So if we see a resistance at 44 and it's starting to get up towards that, which it is, it's heading towards up in that general vicinity soon, then we may decide to tighten the stop. We may also use exactly the same approach to set an initial profit target, and we have one of those on XLU. If it hits 43.80, then we're out of our bought call, and that should give us around about 110% return on investment. And then the staged, what we call stage exit. We don't, I don't personally do staged exits, and what I mean by that is at a certain point, then you exit a portion of the position, and then another portion later on. The reason I don't personally is when I've not found it to work for me, and each individual trader will find things that do work for them and things that don't. I've found no dollar advantage at all with exiting partial positions. And if I look over the years trading, look back over the years trading, and it's an easy thing to work out. So why don't you set yourself the challenge, if you are staging an exit, of actually looking to see whether it's working for you or not over a number of trades, and maybe a critical mass of 20 times that you've done it, and see if it makes any difference at all. If it does, fantastic. If it doesn't, then you either need to tweak your staging system, but also or remove it altogether. So I've generally taken the attitude that an exit is an exit. If the market's telling you it's time not to be in anymore, then it's really quite that simple. And this idea of I'm not losing any money now, because what I've done is I entered a position and now it's given me back everything that it owed me, and then so everything now I make is profit, and it doesn't matter because I've got back what I originally invested. That's, to be honest, that's if I may be blunt and frank, that's actually quite ridiculous in terms of an idea, quite simply because your net worth in a particular position is your net worth in a particular position at any time. It doesn't matter whether you invested a small amount, it's now worth a large amount, or invested a large amount, it's now worth a small amount. The fact is that your net worth in a position is what you actually have in the market at any one time. So this idea of the market doesn't owe me anything really doesn't hold water as a concept. In terms of our loss minimizing exits, we've got initial stops, obviously, and then what we call an event stop. and one of these, obviously because options are a time-limited vehicle, we have a time stop in there. There may be fundamental issues which may mean we get out earlier, and of course we've got what we call a personal stop, which is where really there's other things that are going on in your world that should justifiably have your attention, and therefore you give it the attention. You're not in the best decision-making state to trade, so forget the market, go and sort out what you've got to sort out, and then come back when you're in the right place. So have a look at your system now and decide whether it has all of those component pieces in place. Now, if you can bear with me for a second, I'm not able to see questions, so I'm wondering if any of the guys there can let me know what questions there are, just simply because of the technology issues. I'll just give you a little bit of a show of Hawkeye in action here, but just to reiterate what I said before, there's various ways we can stop. Here's an entry on MBLZ. And what we did with this is we entered it at this point here. We used a stop of a 380R, which is there. So it triggered that nicely and took that off the table. But also we can use Hawkeye for trading range bound. Here's CHK before it dived into a heap later in the year. So we saw an uptrend here. The weekly chart was in congestion, so it felt comfortable putting a small butterfly trade on here. When it entered here, we didn't see it going beyond $17, so we had a 14.50, 15.50, 16.50 butterfly in place, and that pulled us back, stayed within the range, and that pulled us back up 10%. But that's it. You've got to, again, it was matching strategy to market at that stage. Really, directional trading was off the table, so we're looking at other strategies to trade. Okay, on to the 5 major mistakes that options traders make with alarming frequency. In fact, any traders make with remarkable frequency. And so a lot of this reiterates what I've covered already. But firstly, they don't measure their trading beyond profit loss. Okay, the next stage down from looking at those 3 things we talked about before is to look at the actual decisions, the decision making behind your entries, behind your exits. Trade 1 strategy to cover all markets is mistake number 2. You can't just do covered calls if you're doing options and expect to make money in any market, or directional trading for that matter, as we've already referenced. Mistake number 3 is they focus their energies, efforts, and time on entry. Not saying that entries are not important, of course they are, but we need to make sure that we invest our time and effort in exit as well. It's not, and none of this is particularly earth-shattering in terms of being common sense. It's a lot of this is just, it's relatively simple, and I know that's again a message that you're given time and time again. Trading shouldn't be complicated. It's supposed to be simple. It's people that aren't that make it complicated. Mistake number 4 is they fail to recognize how risk changes during the life of a trade. And let me give you an example of this. I've referenced it sort of indirectly before, but if we've got a situation where we've entered a particular position, let's say we've entered an options position or even a directional position, which looking at a chart potentially gives us $1 upside before it hits the next resistance, then once it hits 85%, we've got our potential reward in this position is no longer $1. Okay, it's now 15 cents, and our potential loss is not only our original investment, but also the 85 cents profit that we've made already. So that risk profile of that particular trade has changed. So consider this when you're getting greedy about potentially not tightening your stop up, or what if it breaks that resistance? What if it breaks that line in the sand? If it breaks the line in the sand, you just can enter it again as a completely new trade. So just recognize that risk of it changing. And finally, not giving themselves permission to trade is mistake number 5. It's okay, there's going to be more market opportunities tomorrow. And a bonus 6th, just because I'm a nice guy, is don't shortcut your learning. If you shortcut your learning, you'll shortcut your results. It always staggers me talking to people in a coaching context. We often talk about what people have done before as one of the first things, and it staggers me the number of courses and webinars and seminars and education events that people and programs people have bought and entered, and really have not fully explored the program or done anything with a webinar or done anything with a conference. It's just been something that they've hoped they'll sort of take on by osmosis or some other supernatural force, and stop watching after the first 3 videos because they know it all now. So invariably, those people will not have an edge. It's really quite that simple. So if you're doing learning, embrace it, participate in it fully. This is something that's going to pay you for a lifetime if you do it well, and therefore at the front end deserves that respect and commitment. I'm just going to very briefly talk about weekly options because these are sort of quite popular with people. And unfortunately, there's quite a lot of people out there who are extolling the virtues, and what the approach tends to be is they highlight the reward, so shout it from the rooftops because apparently that's good marketing, and then hide the risk, or give a partial quiet story about the risk. So this is what you'll tend to hear. So weekly options require very little time. It's easy, and you can develop an income every week. But and they'll slap some great percentages beside that, and they'll say it'll only take you 5 minutes a day. You won't even have to look at it more than twice a week. Now, all of that may be partially true, but also you are, with weekly options, looking at a small reward for a potentially very large risk, as we mentioned before. That's the payoff for taking something away from the action and making the chance of a risk event occurring less so. There are trading fees and many weekly options trades that you'll see out there. Really, when you look at them in detail, will be almost unviable because of trading fees associated with them. So you need to add those into your calculations. Not suitable for some markets. Again, you would enter weekly options with caution here, unless you've got another little edge, which I'll mention soon. And one of the strategies that we see often is that let's just roll it over into the position that we've got now, which is a losing position, which is not doing well. Let's just roll it over again, cross our fingers that the market recovers. Every time we do that, we just increase our risk. And again, it's not something that I would in any way, shape, or form advocate or have seen anybody do well with. But with the right information, you can make regular profit. And I've made reference, I'm not going to spend a lot of time on this because those of you who might like the idea of moving forward, we're going to spend a lot of time discussing these in detail. But 2 main strategies we use for weekly options are the idea of credit spreads, so moving the risk event away, and also this idea of holding a long-term call and selling calls over the top to generate income every week. But you need the right things in place. Just going to show you one of the tools that we often use. Here's a Hawkeye Widebar. This is this yellow bar here. This is really a bar that indicates increased volatility in that specific price bar and potentially a period of price stability. But again, for those of you who are less familiar, what we do with credit spreads is if we believe the market's going down, we put our 2 legs above the market. If we think the market's going up, like in this case, we'll put our 2 legs below the market. Okay, so above if we think it's going to go down because the risk of it coming back up the trigger is less. Below if it's going up, because again, chance of it coming down is less so. So for example, at this stage here, we could place a 76, 77 all put spread on Facebook, and that would have not been triggered. We would have got our premium here. The options would have expired when we came. Now, this wide bar is what the dynamite indicator actually is. And it wasn't originally designed for this case. It was originally designed to say, hey, well, look, maybe you shouldn't get on or get in on a day which is doing this. If you missed the initial move, then you need to wait until it's moved over. And here's the price instability we often see after that. But what we noticed is that it doesn't usually come below the Y bar. Okay, so if we'd have entered this position here below this Y bar, then it would have been absolutely fine. So we enter an 83.84, and it always stays over 84 for the next. We're looking for really for the next couple of weeks. Here again, we enter a Y bar here. It doesn't actually have a close price below the bottom of that Y bar in the next couple of weeks. Here again, we'll be short here because it's pointing short. We could look at this, but because we're still in uptrend, then we would leave that alone. We'll just forget that one. But it would have still worked. There's the Y bar, finishes in the last third, place our position here, and it didn't go above 86 in the next couple of weeks. And we can see that time and time again. Here's an ANF chart. We've got a short trade here. You'll see next couple of weeks trading didn't go above that key line. Here we've got a potential uptrend. We place our position here. Doesn't go below the wide bar for the next couple of weeks. This would have been a trade, just to say that it doesn't work every single time. This would have been a trade that goes against us. We would have been caught the subsequent day. But if we'd had an exit strategy which says if it drops below this, then the dollar loss on that position would be minimal. So at the moment, I've shown you 6 different trades. We've had one that's gone against us. Microsoft, here we go again. We would have put a trade here above the wide bar. Again, next couple of weeks didn't hit. We could have gone long with another bull put spread here. Again, trade, and again here another bull put spread. We probably wouldn't have done that because it was pre-earnings, I'm guessing, by that jump, but we certainly could have done one here. Again, would have been successful. So we've got 1, 2, 3, 3 there that we would have taken, 1 that we would have left alone, 3 out of 3. We're in an interesting state now with Microsoft. We potentially, although we didn't because of the way the market is right now, we could have potentially entered in at 48, 49. It'll be interesting to see where that goes from here. Nvidia, same deal again. We've got another trade successful there. See, it went down. There's the last third of the bar. We'll put another bear call there. Went down. We'll put a bull put here. That's moving upwards. Top third of the bar. There's another one. Tick, tick, tick. And so time and time again, you know the power of volume price already. But if we can use that Hawkeye indicator, or if you haven't got Hawkeye, then we can, for those of you who might like the idea of moving forward, then we can, then I'll show you how to do it without Hawkeye, what sort of parameters you need to look at. And this give us 17 trades out of 20. And as I said, with this strategy, win-loss is very important because the potential win is so much smaller than the potential loss, unless of course you had an exit strategy. So all that being said, what we're going to do is give you a little opportunity today. First of all, we're going to give you a chance to, we've got a 6 video series we've just put together actually, which is an options edge evaluation. So what it does is it looks at 6 components of developing an option edge, just short videos, just 5 or 6 minutes each, and you'll do an assessment on each. And that will give you the ability to benchmark where you are now and prioritize what you need to do next to develop your edge. Obviously, you can access that now. The major part of what we're looking at is really, I've called the session my favorite indicator, or we did the 2 sessions. We're going to do 2 live hour-and-a-half sessions, which look at weekly options and the setups for both of those. We're going to talk more about developing an edge and look at some of those other things to measure. There's 4 measuring tools I'm going to that you're going to get, as well as the handouts and worksheets relating to the 2 sessions, which are on the 3rd and the 10th of October. These will be recorded if you can't make it live. We're going to provide an overview of the 8 strategies and look at how and begin to look at how we match strategy to market. So look at those 8 strategies alongside market conditions to get you along that sort of route. We're going to look in detail, obviously, at position sizing. It's pretty important, whatever you're trading. We're going to do that. Give you a calculator now, actually, which you can use, but make sure you've got full knowledge of how to do that for different strategies as well. Look at the 4 internal indicators that if you ignore will get in the way of your trading success forever. There are things about you which you really, really need to get on top of. You don't do this, you won't be successful. It really is that simple. And we're going to look in detail at how you measure your trading and how to develop systems to do this. If you want sustainable profit, you've got to start treating your trading like a business. Any good business is based on great systems that go right across every function of that business. And you can only tell whether those systems are working or not if you measure them properly. Now, I can't emphasize this enough. It's so, so important. What we're going to also do is just throw in a position size calculator, as I said, give you a quick guide to option strategies. And look, for an investment of only $97, which is ridiculously cheap, you're going to get the trading edge videos, you're going to get access to the trading rooms, you're going to get the 2 hour-and-a-half sessions, you're going to get all of the added extras. And if you enroll in the next hour, then what I'm going to do is also give you 2 weeks access to our alert and portfolio service, which is only open to the first 50 people before we close it down today. So that's really what's on the table. And for those